warm welcome to all the participants for today's webinar. I might be a new face to you all. To start off with, I'll introduce myself, Akshara Menon, analyst at PMS Bazar, also the host for today's webinar. And we also have with us Mr. Pankaj Murarka, along with us as a guest. Before jumping into the webinar, let me have a small brief about him. Mr. Pankaj Murarka is the founder and CIO of Renaissance PMS. He has more than 2 decades of experience in equity research and fund management with incredible track record of performance over his professional career. He is a holder of chartered accounts. To talk about his previous work associations, he was a portfolio manager at UTI Mutual Fund and ex-vice president of Motilal Oswal Financial Services Limited. He was also a head equities at Axis Asset Management Co. So before moving on to the presentation, I have a small request to the audience that not to ask stock-specific questions, so that it won't be easy for the people to answer every stock-specific questions. Moving on to you, sir.
Sure. Thanks, Akshara. And good evening, friends. Thank you all for joining us this evening for this discussion conversation, and thanks a lot for taking your time out. What I'm going to do is over the next 40 minutes or so, I'll give you a brief perspective on how we are thinking about markets and the outlook for markets, and also talk briefly about the portfolio strategy for Renaissance Opportunities portfolio, and I'll share the performance of that portfolio also with you all. And then we can open the floor for questions so that we can have a more interactive session. So, friends, we'll talk about markets, but I thought before we talk about markets, all of us understand that over a medium term to long term, a very high correlation between the economy and the markets, right? So before we talk about the market, I thought I'll give you some perspective on the outlook for Indian economy and where we stand. And that is important because today we live in a world where there's too much of noise and there are too many negative data points that are emerging from different parts of the world. If you look around the world, all of us know because of the energy crisis which Europe is facing, there's a high degree of probability, or almost a certainty, I would say, that before the end of this year, entire Eurozone will slip into a recession. Because today, Eurozone, when you look at countries like Germany and some of the other countries, today they're paying something like about 80 rupees per unit for electricity, which was something closer to about 10 rupees in April and May. And that is because gas prices there have shot through the roof. And because Russia has curtailed gas supply, and 80 rupees a unit for electricity, you can imagine what will happen to households. Households are being forced to curb their power consumption, and what will happen to industrial production. So there's a very high probability that probably before the end of the year, Europe will slip into a recession. Given the very sharp rate hikes that US Fed is doing, I would again think, and it's our view, that probably sometime next year, even US economy will slip into a recession. And China, all of us are already seeing that the growth is slowing very sharply. In fact, some of the very experienced people who've been tracking China for the last 20-25 years and who understand China really well, and they are of the opinion that in fact Chinese economy as we speak is already into a recession, because you don't trust or you don't take at face value all the data that's coming out of China. But given the fact that about 30% of Chinese economy is real estate, and real estate sales are negative, and the kind of impact this whole COVID-driven lockdowns is having, there's a very sharp deceleration in consumption in China as well. And people believe that Chinese growth could already be negative. In that context, what I wanted to highlight was India really stands out, because probably when we look at the next year or the next 3 years, then India really stands out because, as you know, most of the major economic blocks are already into or likely to slip into recession over the next 12 months. And which is where I think the resiliency of India comes. So I think India has been an extremely resilient economy. And I firmly believe that Indian economy is in sort of a growth super cycle, primarily because we have a very large domestic economy and a very large demand in the domestic economy. So while we depend on the external world, but at the same time, our domestic economy supports our growth. And rightly so, the government of India has taken some very some very concerted policy efforts to drive growth in India's economy. One of the biggest reform from government has been this whole PLI linked incentive, which is leading to revival of or renaissance revival of India's manufacturing. All of us know now that government gives incentives for setting up new manufacturing capacities in India by either Indian companies or foreign companies, where they have to achieve certain desired turnover or revenue in terms of sales locally and export and globally in terms of exporting from India, and that's leading to setting up of new manufacturing in India. So I think that's a very big ticket reform which government has announced about almost 2 years back, and over the last 2 years, government of India has already committed something like about $30 odd billion of subsidy to under PLI scheme to different sectors of manufacturing in India over the next 6 years. And our assessment is that all the PLI linked manufacturing and its second derivative in terms of the ancillary units that will come up to support PLI linked manufacturing, all of them can cumulatively add something like about 1% to India's GDP in 5 years' time in FY27, when we'll see the real big impact. So I think that's a very positive and a very significant step in terms of driving of India's long-term growth and significant positive for Indian economy. At the same time, we are seeing strong signs of recovery in other pockets of the economy as well. For example, if you look at real estate is one sector which pre-COVID was into quite a bit of trouble for the last 5-6 years pre-COVID, but we've seen a very sharp recovery in real estate as a sector, and we know that real estate is a very big sector in the economy and has a direct bearing in terms of revival of so many other industries which are associated with the real estate. If you look at the real estate sector, because of the because prices have been flat or have fallen over the last 6-7 years, affordability has really improved, and over the last 12 months, or in fact last 18 months, if you look at the top 10 metro cities in India, then 8 out of the top 10 metro cities have had their highest real estate sales month on month basis over the last 18 months in the last 15 years. That shows us the kind of strong consumer demand or the demand that has actually emerged in the real estate sector. And our view is that this whole revival in the real estate sector will continue over the next 3 to 5 years, because there is a very strong pent-up demand both in the residential and one in the residential segment, and more importantly, now we are seeing demand emerge in commercial and retail as well. So collectively, all taken together, real estate sector being one of the key sectors in the economy will revive very significantly. Likewise, after a very long time, we are seeing revival in bank credit. So one, overall credit growth in the economy is pretty strong. And secondly, after a long time, we are seeing revival in industrial credit. So industrial credit, which was very weak, even pre-COVID, for 3-4 years pre-COVID, industrial credit was extremely weak because industries were not doing new investments or new capex. That we've started seeing early signs of recovery, and that's very heartening. And that also relates to the fact that we're seeing revival of private sector investment cycle, which was completely absent for the last almost 10 years. So net, the point I wanted to make, friends, is that given the in the backdrop of environment where the world economy or major economic blocks in the world are clearly challenged, Indian economy remains in a very sweet spot and is an outlier in that sense. Collectively, cumulative effect of all of this, what we're seeing is a very sharp revival in corporate profitability in India. So corporate profits, which are as a percentage of GDP, which has dipped to as low as 2% or under 2% in FY20, is now bounced back smartly to 5%. And that is also reflected in the strong earnings growth that we've witnessed in index companies and in corporate India. You'll recollect that even pre-COVID, we had a very sluggish economy. In fact, over the 5 years pre-COVID, the Nifty index earnings growth was just about 3.4%. So that is the kind of sluggish earnings growth we had. I'm not going into the details, but I'm sure all of you are aware of the kind of disruption that happened in the economy at that point of time, starting from demonetization, banking NPAs, then GST, then the real estate bill, and so on and so forth. But the good thing is, post-COVID, we've had a very smart recovery in our economy. Over the 3 years post-COVID, FY21 to FY23, Nifty earnings have been growing at a CAGR of 23.5%, which is very strong earnings growth that we are witnessing, courtesy the strong revival in the demand that we have seen across all the broad-based sectors of the economy. and more importantly, a strong recovery in corporate profit that we've seen. Sum total all of it, just to give you a very high level big picture, friends. If you look at the end of the day, we know markets are slaves of earnings. So for index to give returns or companies to deliver returns, their profits and cash flows have to grow. Now, how do we, if you put the last 15 years in context, so this is just to show you that Nifty earnings, we've had a very sluggish decade between 2010 and 2020, where our growth was very moderate, and more importantly, because of multiple headwinds we have had in that decade, earnings growth for Nifty companies had slowed very sharply. So effectively, between FY10 and FY20, it took 10 years for Nifty earnings to double. Nifty earnings went from 250 rupees to something like about 470 rupees. So it's almost nearly doubling, but it took 10 years to do that. And over a 10-year period, they had an earnings CAGR of 6.6%. The good thing is now the same thing, which is effectively doubling of Nifty earnings, which took 10 years, is happening in the next 4 years between FY20 and FY24. We are again doubling Nifty earnings. That's the power of strong, that's a reflection of the strong underlying demand or growth that we've seen in the economy across sectors. I am firmly of the opinion that given, as I said, given the challenges that lies across all over the world, India still remains an outlier economy in that sense. And India will still continue to deliver very healthy growth over the next 5 years, while the world will continue to remain challenged. As I share with you, we're seeing a strong revival in India's manufacturing because of PLI-linked incentive schemes. There's a very strong domestic demand in India across sectors. Real estate is one of the prime examples of that, and likewise across consumer durables or consumer discretionary, as well as autos as well. Because the hiring markets are very robust, job markets are pretty robust. In fact, hiring trends that we see across industries are very strong. Job creation in the economy is very strong. Last 3 years, IT companies in India have hired very significantly. Just to give you one data point, if you take the top 5 IT companies in India, which include TCS, Infosys, HCL Tech, Wipro, and Tech Mahindra, in a single year, they were hiring 50,000 freshers in FY20. In FY19. Post-COVID, last 3 years, the same top 5 IT companies have been hiring about 3 lakh freshers collectively. So what the top 5 companies which were hiring 50,000 fresh engineers have hired 3 lakh fresh engineers in the last 3 years continuously. Now just think about it, when these people, when they get hired, and over the next 2 to 3 years, they're spending money in terms of either buying an iPhone, buying a car, probably 5 years out trying to buy a house, and so many things, and the kind of cascading impact it has on the growth in the economy. So the point I was trying to make is domestic demand and growth remains extremely resilient. And in context of that, I feel Indian markets will do well over the medium term. In the short term, we have had a very sharp rally over the last 2 months from the lows we made in the May. And if you see, this year itself has been a complete roller coaster year, because we started the year in January at about 18,000 odd Nifty, and now after the dip in March, April, May, because of the fears of this Russian war, and when the fear receded, markets rallied back. In September, we've come back to the same 18,000. So my view is probably, given the sharp rally that we've seen in the last 3 months, near-term markets can remain range-bound or sideways. But if one were to look at equities from a 1 year, 3 year, and a 5 year time horizon, and probably longer, we remain extremely constructive on the outlook for Indian equities. In fact, I think Indian equity is the most exciting place to be in, and probably it'll be the best performing equity market in the world, because no other economy promises the kind of growth that India can deliver over the next 5, 10, 15, 20 years. And I'm sure all of you all know this year India is the fastest growing economy in the world. And more importantly, will continue to remain the fastest growing economy in the world now for the foreseeable future over the next 20 years, because China's growth will keep decelerating, and on the contrary, India's growth will keep accelerating. So effectively, we'll keep being the fastest growing economy in the world for the next 20 years or so at least. And the resilience of Indian market is also reflected from the fact that if you see from October last year to June this year, foreign investors sold highest amount of stock they've ever sold in the history in India in a single year. So the highest so far they had sold was $26 billion in single year, and that was in 2008. Last 1 year, between October to June 21, they ended up selling $35 billion of Indian equities. Last time in 2008, when they sold $26 billion of Indian equities, the markets were down 50%. This time they sold $35 billion, and yet the markets were down just about 18%. So that shows the depth of the Indian market. In terms of how we've evolved and how broad-based we've become, and more importantly, how strong markets have become in that sense. So, friend, the outlook, in my humble opinion, I think every dip is an opportunity to buy into Indian equities over the next with a 3 to 5 year time horizon, and I feel extremely constructive on the outlook for the economy. I'm sure all of you read sometime a couple of days back there was a news item that India now is the 5th largest economy in the world, and in probably 3 years time will also become the 4th largest. Will overtake Germany as well, given our growth trajectory. So probably in 3 years time, by 2025-26, will become the 4th largest economy in the world, and which will be behind the US, China, and Japan, and we will be the 4th largest economy in the world. So that being that, I thought I'll just give you some more highlights. Given the fact that, let's say, I'm so bullish on or positive on Indian markets from a medium to long term perspective, I thought I'll share with you some interesting insights in terms of which are the big macro themes or big long-term themes which are likely to play out in India over the next 10, 20 years, and which is where we would like to invest our clients' money, and which looks what we call the big wave surfing. I don't know how many of you all know or have practiced surfing as a sport, but this is akin to the big wave surfing when you surf on high tides. So I thought I'll take this opportunity to share some of those things with you. So one, I think, friends, one of the big mega trend that's already playing and going to play out in India across over the next 20 years is financial services. I think financial services, every business across every segment of financial services has a very huge growth potential in India over the next 20 years. Be it our traditional banks and NBFCs which do the lending, or be it when it comes to managing wealth or wealth creation, be it the asset management companies or financial advisory or wealth management or stock exchanges. And we have companies across all these businesses which are listed which are listed in the public markets. I think all of these businesses are going to have very strong growth over the next 15-20 years, because in India we'll see a very strong growth in per capita income. India, as it is an economy with very high savings and investment, so as household savings increase and that money is channeled back into the economy, either in terms of bank deposit or investment, fixed income mutual funds or equity mutual funds, I think all people in the entire ecosystem of financial market will have very strong growth. Likewise, credit, all of us know, plays a very important role in the entire ecosystem, because whether it's a consumer, they borrow for their credit cards or personal loans or housing loans, or companies, whether they're taking credit, working capital loans or term loans. So credit is the heart of the economy. So I think India is going to witness, as our growth accelerates, very strong credit growth, and all the players in the credit ecosystem again will have very strong growth over the next 10-15 years. And likewise, when it comes to contingency planning or planning for life, be it insurance across life and general, or pension funds and provident funds, and so on and so forth. So the point I'm trying to make is financial services is still very underpenetrated in India, and given the rising per capita income, high savings and investments in India, the entire gamut of financial services will do extremely well over the next 15-20 years. And we feel very excited about it. The second big wave or the big trend that we are seeing, friends, is a very strong increase in discretionary consumption. Over the last 15 years, consumption basket of India is changing very rapidly. Discretionary consumption, and now that India is at that inflection point of about $2,500 of per capita income, we think over the next 5 years and 10 years, once you cross something like $2,500 of per capita income, which is where we are, we see a very J-curve effect in consumption, discretionary consumption, and most of the countries across the world, have witnessed something like that. And I think which is what India is going to witness. So we discretionary consumers or consumer discretionaries will do very well over the next 10-20 years because, as I said, rising per capita income, strong job creation in the economy. India will be the largest supplier of talent to the world because we'll have 10 million people joining our workforce every year. 10 million new people joining our workforce because of our demographics every year, and this will continue for next 20 years. So effectively over the next 20 years, we'll be supplying 200 million people to the world in terms of working age population. Now, when you add such a large pool of people to productive jobs or roles or services on a sustained basis over such a long period of time, obviously one will have strong growth, will have strong productivity improvement, because these people are not going to go and work in farm, which are low productive jobs, but they're going to work in manufacturing or services sector where productivity levels are extremely high. And on top of that, we'll have rising per capita income. Per capita income will rise much faster than overall nominal GDP growth because of the improvement in productivity ratios. And then all of these consumers are going to spend money. So which is why I think consumer discretionary are going to do extremely well over the next 15-20 years. The third big trend, friends, is internet economy. India's internet economy, if you combine everything taken together that's around, is about $100 billion. So it's about 3% of our GDP. We think over the next 7 to 8 years, India's internet economy will grow 4x. It can easily grow. If Indian economy is growing at 7%, we think India's internet economy will grow 3 times that. It can comfortably grow at 20% CAGR. Friends, I feel very excited about India's internet economy and the potential it holds. And I think there's a huge amount of wealth creation that will happen in India's internet ecosystem. Just think about it in terms of the kind of wealth creation that has happened in internet companies in the US in the last 20 years. And I firmly believe that something similar in terms of growth in internet economy and in terms of wealth creation in the internet ecosystem will happen in India over the next 20 years. I have no doubt in my mind about that. So I'm a firm believer in that. And then, as I said, we are seeing a strong revival of India's manufacturing across sectors, across segments. So we like consumer electronics as a sector where we are seeing a strong revival in India's manufacturing. We are seeing a lot of companies setting up units in India for manufacturing and selling not only in India but selling all over the world. India, which was 0% in terms of manufacturing of iPhone, which is the largest sold consumer product in the world. iPhone is the largest meaning in terms of one single product, is the largest sold or the highest value consumer product in the world. No other consumer product has been as successful as iPhone. And now probably this year India will manufacture about 3% of iPhone's global production, and probably in 3 years time we should be 15% and probably higher as well. Right? So that shows the kind of strong growth we are witnessing in consumer electronics manufacturing in India. Likewise, with chemicals, we're seeing strong growth in chemicals manufacturing in India because the entire chemical ecosystem or supply chain is concentrated in China, and all the global companies want to diversify and de-risk their supply chain from China. They want to have a second base, and India is a very attractive value proposition given the kind of incentives the Indian government is giving. So it becomes very attractive, and we're already seeing strong trends in shift in production in chemicals from China to India. Likewise, we're extremely bullish on contract research and manufacturing. My view is that CRAMS as a sector, probably India will become the leading country in the CRAMS sector. Just like India has become the leader in IT services in the last 20 years, India will also become a leader in CRAMS in the world over the next 15-20 years. And finally, autos. I think there's a huge potential in passenger vehicle growth in India, and more importantly, using India as a manufacturing base to exports to a lot of other countries across Middle East and Africa, and maybe some European or Eastern European countries also from India. Probably in 10 years time or 15 years time, India will, as it has become the third largest passenger vehicle market in the world after China, US, India will probably be the third largest passenger vehicle market in India. So we like autos and auto ancillaries as well. So I think Indian manufacturing, it's the time where we see Indian manufacturing will take a leap over the next 15-20 years, and we feel very excited about that. So that I thought I'll share that with you friends in terms of how we are thinking about it. Meaning these are some of the themes which we feel very excited about when we look at India and what's happening in the Indian economy. These are the sectors and companies within these sectors really excite us. I'll quickly move on to give you a brief introduction about Renaissance and talk about our Renaissance opportunities portfolio in terms of the investment philosophy of the fund, and probably give you a quick insight into the performance of the fund, and then we'll open the floor for questions. So just a quick introduction of myself, friends. I'm the founder of Renaissance. I'm also the CIO. I've been around in equities, in the world of equities as a professional fund manager for the last 25 years. Over the years, I started my career in 95, and over the years, I've worked with some of the leading asset management companies in India and some of the leading firms in India, from UTI Mutual Fund, where I started my career, to Merrill Lynch, Axis AMC, and some of the other firms. And I've had some pretty healthy track record of performance during the course of my career, and have won multiple awards for the for performance of my funds over the last 15-20 years. And also I've been recognized by Outlook Money and some of the other agencies as they were appreciated and acknowledged my performance as amongst being one of the most consistent performance over a long period of time in India, and amongst the leading performer in terms of fund performance in India. Apart from that, this is my another colleague, Pawan Parak. Is a fund manager with us. Pawan is a rank holder chartered accountant, has been with Renaissance right from our inception, and is an exceptional professional, having worked with some of the leading firms or institutions in India like Deloitte, HSBC, and HDFC before he joined Renaissance. So Pawan is a fund manager with Renaissance with about 15 years of experience, and runs some of our PMS and AIF funds. Very quickly, before we move on to Renaissance Opportunities Fund, I thought I'll give you some high-level insight into our investment process and philosophy. What we call, friends, our whole investment framework works around this 4P, what we call the 4 pillars of investment. You all will appreciate that investment managers or fund managers are judged on the basis of their performance. But unfortunately, any fund manager has little control on the performance of his fund, because the performance of a fund is a function of the performance of the underlying companies, fundamental performance of the underlying companies, and also the stock price performance of those companies. And generally, fund managers, despite their best effort, meaning they can do their analysis, but they can't control the performance of their company. And which is why we always say that performance is an outcome. What we need to focus as fund managers, and while we don't have control on the outcome, we need to focus on the inputs that go in creating in that output, and which is what we call the 3 Ps. The first is to have a clearly articulated investment philosophy. Second is to have very evolved processes to run your investment processes. And finally, howsoever good your processes are, eventually it's the team that matters, because it's a people's business. So have an excellent team of professionals to run that. And if we get the first 3 Ps right, then the 4th P performance will automatically fall in place sooner or later. So I thought I'll share with you, give you some insights into that. So we have a very clearly articulated investment philosophy at Renaissance. We are focused on, as investors, we are growth biased investors. We are always looking to invest into growth companies, high growth companies, because we firmly believe that over a medium term to long term, there is a very high degree of correlation between the shareholder returns and the growth in cash flows and profits of the investing companies. So probably if you buy a business at a fair valuation or right valuation, then and if that business delivers high growth, then shareholder returns can be really very attractive over the medium term to long term. So we want to invest into high growth businesses. Having said that, we follow this whole investment framework of what we call SQ-GAR, which stands for Sustainable Quality Growth at Reasonable Price. So the point is that while growth is important, what is equally important, friends, is the quality of growth, because growth can be both good quality and bad quality, and it's very important to distinguish good quality growth and bad quality growth, because good quality growth will be value accretive Whereas bad quality growth will be valued destructive, and you don't want to invest into bad quality growth, because then in that case, despite buying into a growth business, we can still end up losing a lot of money, and we clearly want to avoid that. So it's very important. While growth is important, quality of growth is equally important. And finally, we want, as investors, we are very long term in our approach, so we want sustainable long term growth. So, which is why sustainability of that growth is very important. We want that growth to be enduring over a period of 10, 15, 20 years to have the real compounding effect of wealth creation. So which is why we want sustainable growth and we want good quality growth. And once we get all of that, all we need to do is we want to buy that growth at a fair price. As long as we can buy it at a reasonable price, we are happy with. We are okay. We are fine with that. So our investment framework revolves around this whole architecture of what I said, investing into businesses which can deliver sustainable quality growth at reasonable price. What are we trying to achieve? We're trying to achieve superior risk-adjusted returns. Friends, the idea is very simple. If I ask any of you what kind of returns you want from your equity investments, the general answer I would get is everyone wants high returns. Who does not want it, right? And the next question is then what do you do to generate high returns? And then the more often than not, the answer is that you have to take high risk, because unless and until you take high risk, you will not generate high returns. But let me tell you, friends, that high risk does not translate into high returns in the world of equities, because the correlation between risk and return in equities is not linear. It's a bell-shaped curve. So if you take low risk, one would certainly generate low returns, but people who take high risk or highest risk end up, because equity markets are cyclical, after every bull market there's a bear market and vice versa. Whenever the cycle of market turns, people who've taken high risk will certainly lose a lot of money. And which is why people who take high risk in equities, where the risk reward ratio is adverse or negative, do not generate high returns, they generate low returns. The path to sustainable high returns in equities is through superior risk adjusted returns, and which is what exactly we want to deliver, and we endeavor to deliver at Renaissance. We want to make sure that all of our funds are delivering, generating alpha and generating superior returns for every unit of risk we're taking. And it's my firm belief, and there's enough data to show that, demonstrate this. Anyone who can do this, not only in India but anywhere in the world, will automatically become the best performing fund manager. So at Renaissance, our focus is very clear. We want to focus on generating not the highest returns, because the highest people who are generating the highest returns are also more often than not taking, on a short-term basis, people who are generating the highest returns are more often than not also taking the highest risk. And we don't want to be taking the highest risk, because people who take highest risk eventually on a medium-term to long-term basis generate low returns. Because when you take high risk, that risk will come and hit you or bite you at some point of time or other. There are no free lunches, friends, nowhere in the world, least in the world of equities. So we want to focus on generating superior risk-adjusted returns for our portfolios. Yeah. So I thought I'll give you a very high-level view on that, and then I'll quickly jump onto a Renaissance Opportunities portfolio. So idea with Renaissance Opportunities portfolio is very simple, friends. It's a high-quality large-cap portfolio. And we firmly believe that large cap investing has become a significant challenge for investors from a mutual fund perspective, because this analysis, this study which was done by Business Standard, and this data as of 31st December last year, which shows that if you look at this green bar on the extreme left end, it shows that on a 5-year basis, 82% of large cap mutual funds underperform the benchmark. Then the question is, if someone wants to do large cap investing, because large cap are the safest one, then how do you do that? Because 82% of actively managed mutual funds on a 5-year basis as of 31st December are actually underperforming the benchmark index. And likewise, when you look at multi-caps or ELSS, 80% of ELSS funds are underperforming the index BSE 200 on 5-year basis. So then the question is, how do you generate sustainable alpha while investing into large caps or multi-caps? And we believe Renaissance Opportunities portfolio is an answer to that. It's a high quality large cap portfolio. The way we go about constructing this portfolio is very simple. We take the total universe of large cap listed companies. At the last count, we do this twice a year. It was 156. When we apply our quality filters to these companies, then some of these companies do get eliminated because they don't meet our quality criteria, and we were left with about 124 companies in our universe. Then we filter those companies on the basis of which companies which can deliver. Being growth biased investors, we're looking for high growth, healthy growth, companies which can do at least minimum 15% earnings CAGR over the next 3 years. And we narrow it down to 78 companies, and we create the Renaissance Opportunities portfolio of about 20 odd stocks from these 78 companies. So idea is very simple. Renaissance Opportunities portfolio is a focused large cap portfolio. It has about 20-25 companies, and it's a good quality growth bias portfolio. So quality is important, growth is equally important, and at the same time we want to buy quality also, and we want to buy growth also, and we want to buy all of this at a fair price or a reasonable price. So it's a portfolio which is a classic blend of growth and quality, and it's a portfolio which is built on best opportunities that are available, focused portfolio. I can give you some classic examples of stocks which we have held in the stock and which has worked very well for us. For example, ICICI Bank has been one of our early holdings in the fund, and we've been holding it for now almost last 4 years. In fact, we've been overweight ICICI Bank right from 2018, when the bank was not doing as well and probably was in news for negative news flow around NPAs and all of that, and we thought that was temporary and they're near the end of the problem. And if you see over the last 4 years, the stock has done a 39% IRR for us over the last 4 years versus a Nifty IRR of 16%. So when you have a significant overweight on something like such a large stock by a wide margin and gives you such a significant outperformance, it makes a significant contribution to the profits of the makes significant contribution to the performance of the fund and helps us in creating meaningful alpha. Likewise, another big holding, meaning another stock where we've had a very big alpha has been Tata Motors. We bought the stock in October 19, and we've been holding this stock even now. As of June 22, last 2.5 years, this stock has given us a 99% or almost close to 100% XIRR. So it has effectively become a four-bagger for us. From where we have bought versus a Nifty XIRR of 15%. So you can see the massive outperformance we've been able to generate out of some of these large cap names by buying them, one, at the right time, and secondly having a significant exposure to them in the fund, and thereby contributing to the performance of the fund. So I'll give you some quick highlights in terms of, now this is some just very highlights into some of the companies that we've held in the fund or continue to hold, and what price we would have bought them and the kind of contribution they've made to the portfolio over the last 3 years. So Aditya Birla Fashion is another big holding in the fund. We bought it at around 150 rupees average price, and over the last 3 years the stock has doubled. So it's given us a 30% XIRR versus a Nifty XIRR of 15-16%, and likewise with Sun Pharma and Tata Power. So you can see in terms of what, to give you a high level insights into the fund, how it's been doing. We did a, this is data as of August 22, so this is a very recent data. We did a comparison, friends, for benefit of you all, of our Renaissance Opportunities portfolio with some of the other mutual funds and PMSs. So hypothetically thinking that if our opportunities portfolio was a mutual fund and we compare it with all the large cap mutual funds, then on 1 year, 2 year, 3 year basis, each of these categories, it's the number one performing large cap fund if it was on a mutual fund platform. So the point I'm trying to say is, as I showed to you earlier, that 80% of the large cap mutual funds underperform the benchmark over 5 years and 70% underperform of the benchmark over 3 years. We have not only beaten the benchmark, but we've just been outperforming all the large cap funds. Likewise, if we compare it with all the flexi cap and multi cap mutual funds, then our rank is 6 and 9 on a 2 year and 3 year basis, despite the fact that our exposure to mid cap, small cap is much lower than what a typical multi cap, flexi cap fund would have. So which again demonstrates the point that, if you get a stock selection right, then even with lower mid cap exposure, lower risk, you can generate very healthy alpha. And if you compare it with all the large cap PMSs, then it's on a 3 year basis, it's ranked number 1 out of 20 odd funds that's out there. So if you look at the returns, on a 3 year basis, the fund has done a 22.16% CAGR returns in absolute terms. Last 1 year, it's done 18.7% return versus a Nifty 200 returns of 5%. So you can see the kind of healthy alpha trends we've been able to generate on this portfolio over 1 year, 2 year, 3 year basis. And that too without taking significant risk, because it's a large cap portfolio, so 75-80% of the portfolio is large cap. And I showed you some of the examples. We're investing into tried and tested and well-known companies in India, and yet able to deliver this kind of alpha that we've been able to generate. So the idea with this portfolio is very simple. I call it a low-risk equity portfolio because equity is risk at the end of the day. So the question is, all of us want to make healthy returns out of equities, but at the same time, we want to manage the risk that is associated with investing into equities. And I think the answer to all of this is Renaissance Opportunities portfolio because it's a low-risk equity portfolio. Because it's a focused portfolio about 20 odd companies, it's a very high conviction portfolio. It's low risk portfolio because it's large cap bias. So these are large cap companies. 80% of the portfolio is large cap. So these companies will never go out of business. So money is safe. We can never have permanent loss of capital in this fund. These are high growth companies. So we're investing into high growth companies which expect to deliver very healthy returns over the medium term to long term. And while investing into high growth companies, we're equally focused and conscious about high quality businesses. So it's a very high quality portfolio. And also these companies are business leaders. They're leaders in their respective business, which effectively means they're last man standing in their respective industry. So if there's a competitive intensity or something plays out in that industry, for example, let's say take an example of telecom industry. 5 years back or 7 years back, we had about 10 players in the industry. Now we are left with 3. But Bharti, being a industry leader, is the last man standing. So when the consolidation was happening in the industry, Bharti was never at risk, and they're the last man standing. And then they've created enormous value and wealth for shareholders over the last 2 years. So likewise, each and every company in the portfolio is a leader in their respective industry, which effectively means they're the last man standing in a very vicious competitive environment, and which effectively also means that they'll never go out of business and there will never be a permanent capital loss on any investment in the fund. And finally, as investors, we are long term in our approach and we like to buy companies, and then if the companies are doing well, just hold them for a long period of time. So I thought, friends, that's a very high level perspective on the fund I wanted to give, and we've covered, I've shared with you some insights into Renaissance investment philosophy as well, and we've touched upon the markets as well. It's on the dot. I've been talking about 45 minutes now. So I'll pause here and we can open the floor for questions so that we can make the session more interactive. I'm happy to answer questions that you all might have, friends.
Thank you, sir, for this wonderful webinar on the topic. So we have got a few questions from the forum. I would like to put it up. From Sailesh Mehta as well as Anand, they've got some similar question. Just like if Europe, US, China will see a slowdown or global recession, then what makes you feel that India is decoupled from this effect? So both of them have a similar question.
Sure. See, friends, India is largely decoupled. I'm not saying it's 100% decoupled, but the fact is that we have a very diversified domestic economy. Very few countries in the world have such a large domestic economy. US has it, Europe as a continent has it, but and China has it. And most of the other countries in the world do not have such a large domestic economy, which is why they are dependent on the external world, the external trade, exports and imports to drive their growth. So let's say look at China or Korea. Taiwan, 60% of growth is exports because semiconductors and whatnot. Korea, again, about almost 40% of their growth is exports. In case of India, our dependence on the external world or our total exports is just about 10-12%, 12% of our GDP. International trade is about 25% or 30%, but 30% rather, but our exports are just about 12%. So if the global economy goes into a recession, there can be some impact on global growth, on India's growth. But the point I'm going to make is the impact on India's growth will be very small or negligible as compared to what the rest of the world will feel. And we can still grow because in India, as I said, we have a very large domestic economy where and that can continue to keep India very stable in that sense. So the point I'm going to make is there will be some impact, but it will be much better. Most of the when we talk about recession, what effectively it means is US, Europe will have negative growth. In India, what will happen is our growth will moderate from let's say 8% to 7% or at worst 6%. So, but we'll still be growing at 6% in an environment where all the other countries in the world will be having negative growth. So that's why I say India will be much better placed relatively versus the other major economies in the world.
Okay, sir. Thank you. So one more question that popped up is that it is evident that IT index continuing their losing streak. Will IT witness more pain further? IT sector?
Yes, in the short term, yes, I would say yes, because if US goes into a recession and Europe goes into a recession, then IT companies sooner or later will see some impact on their business. Though I still think long-term outlook for Indian IT sector remains very strong because now these companies, while they are based out of India or they are Indian origin companies, most of these our IT companies are now global companies. They are among the top 10 companies globally when it comes to IT services. Be it TCS, Infosys, Wipro, HCL Tech, they are amongst the top 10 IT services company globally. So they are very much global companies. And in that context, when some of the two major economic blocks of the world, US and Europe, if they go into a recession, I think sooner or later it will have some impact on their growth prospects. So in the short term, there will be some impact on IT sector, and which is why we, for example, at Renaissance, we are underweight IT as a sector across all our portfolios.
Okay, thank you, sir. So we're talking about the e-commerce sector. So one more question on that is that e-commerce is growing around 18 to 20% with better internet access, and we have this 5G adoption. So what do you think the sector would do in the next 5 years?
As I said, friends, I'm very excited about the whole internet economy in India. I think over the next 15 years, internet will be the fastest growing sector in the entire Indian economy. And to my mind, India's internet sector is exactly where IT sector used to be in the late 90s. When IT services was small, Infosys was a mid-cap company, and a lot of other IT companies like HCL Tech and all of them were actually mid-cap companies. Now you just think about them; all of them today are the leading companies of India. They are part of the Nifty index, and they are amongst the global leaders in IT services. So I think today internet sector is as small as the IT services sector was probably in 90s and 2000, and over the next 5-10 years it will grow exponentially. So I shared with you, I think over the next 7-8 years, from $100 billion, our whole internet economy or digital economy, as we would like to call it, will become $400 billion by the end of this decade.
Okay. Okay, thank you, sir. So moving on to the auto sector now, we have Venkata K. Reddy. If I'm sorry if I'm pronouncing a spelling wrong. So yeah, he was more curious to know about the EV vehicles, more like in auto sector. Auto sector has been underperforming like, for past 5 years now, and what is your outlook for autos once it pent up demands comes down?
So you're right, there's a lot of pent up demand in the auto sector, and that's primarily because a huge shortage of because of supply side dislocation and constraint of supply which auto companies have witnessed because of constraint of supply of chips and other things. Now the chip supply is normalizing, and which is why we're seeing production normalizing for auto companies, and probably over the next 9 months or so, demand should normalize in that sense. Next 1 year or so, because there's a lot of auto companies for a lot of models are sitting on 6 months waiting period now, which is ridiculous that customers have to wait 6 months to get a car. This is like Stone Age, where meaning customers have to wait for 6 months for getting a product is really ridiculous. But I think all of that will get normalized over the next 1 year. But apart from that also, I think the sector will remain in a strong growth trend over the next 10 years because as job creation happens, as people get new jobs, people are going to buy a new car at some point of time. Every person who gets a job at some point of time, he wants to buy his first car and then he wants to upgrade it to a better car. Meaning my father bought his first car, Maruti 800. We were so excited, and then he upgraded, and we upgraded, and all of that. So I'm sure. See, the ownership of cars in India is still very low. So there's a huge potential given our population base, and given the kind of growth India is going to witness as an economy. I think probably will become the third largest passenger vehicle market in the world. probably in 15 years time. Today China is the largest passenger vehicle market in the world and the US is the second largest. I think India will become the third largest passenger vehicle market in the world over the next 15 years. So if you ask me, as far as passenger vehicles are concerned, cars are concerned, friends, I think it's a secular growth trend in that industry over the next 15 years. That sector will keep growing year after year, year after year for the next 15 years. So I don't see any growth concerns in that sector.
Thank you, sir. I just make it as a follow-up question that when you said China was ahead of us in auto sector, there's some policy called China Plus One, and manufacturers finding is a stability in China, and can India can become a manufacturing hub in upcoming years? Can we expect that? Because as you said in your presentation, that iPhone manufacturing will be soon seen in India. So can we expect India to be a manufacturing hub?
100%. Because see, the point is today, because of alignment of a lot of initiatives, the world has no other choice. I'll give you a small example. Today now, when you set up new manufacturing unit in India, Government of India has said for new manufacturing unit, tax rate is 15%. This is the lowest tax rate you can get anywhere in the world. Yeah. So India has the lowest tax rate on new manufacturing. Government of India is giving incentive in terms of PLI. That's the second added advantage. Wage cost, China is not cheap anymore. Wage cost in China is 5 times India. So India has the lowest labor cost or wage cost in the world now. So that's the third advantage of setting up manufacturing in India. Fourth, I'll give an example. The largest manufacturer, for example, you take Apple because that's the largest consumer product. Now the largest manufacturer of Apple is a company called Foxconn. I'm sure all of us know this. Now, one single Foxconn employs 1 million people in China. Now, if Foxconn wants to manufacture or set up manufacturing on a very large scale, they cannot go to any other country in the world and hire 1 million people because 1 million people are not there. The population is so small. You can't hire 1 million people in Vietnam because there is no 1 million labor force in Vietnam of that working age to be hired by a single company. So you can hire one single company hiring 1 million people. That can happen after China. The only place on the earth where it can happen is India. So companies wanting to do large scale manufacturing at cheap cost, cheap labor cost, low taxes, government incentives, they have no choice but to come to India. And you see 2 days back, it's been the newspaper now, Foxconn and Vedanta are setting up a semiconductor unit in Gujarat. It's been there in newspapers all over. You see the way state governments are going out of their way to get these companies to come and invest in India, and the kind of incentives they are giving to these companies in terms of waiver of state GSTs, waiver on electricity duties, waiver on the labor taxes, and so on and so forth, because they realize that we need these kind of investments in India and in their respective states because of the kind of job creation it will do and the kind of ancillary manufacturing it will drive in the state. So which is where states are competing amongst themselves to get that manufacturing in their respective state. So the state incentives are in addition to what all the central government is giving. So I think India is a very attractive place for anyone to look at manufacturing. When you look at globally, when you want to do large scale manufacturing, small things here and there you can manufacture in different parts of the world. You can go to Thailand, you can go to Vietnam and all of that. But we have to do on a very large scale manufacturing. Then India, there is no other alternative to India. And rightly so, central government and state governments are giving a lot of incentives and subsidies to attract this investment. So I think probably take a longer term view, 15-20 years, and India will become a global manufacturing powerhouse. I have no doubt in my mind, friends, about that.
Thank you, sir. One question, like 2 to 3 people are common about is that what's your view on crude prices and its effect on Indian market when Western world are on the edge of recession? Because crude oil is always on talk when you talk about inflation or recession. So what is your view on it, sir?
So one, friends, I must confess, I'm not an expert on crude, but obviously I read a lot and I talk to a lot of people. So from whatever I understand, one, it's a given that we are in a global environment where commodity prices, including oil, will remain elevated for the next 5-6 years. Because in the last 7-8 years, because of these concerns of ESG and climate, the world has not invested into new capacities, be it copper, be it steel, be it aluminum, and oil as well. As a result, last 7-8 years, what has happened is the demand has grown and the production is the same. So now when the supply gap is bridged, because supply has not increased and demand has grown, prices of all these commodities will remain elevated. I'll give you one example. 2013, we are in 2012. So 2012 to 2022, last 10 years, all over the world has not created new copper production capacity. The copper production capacity in the world today is exactly the same as it was in 2012. Now, the last 10 years, the demand for copper has increased significantly. And if the world is moving towards electric vehicles, then electric vehicles consume significant amount of copper. So it will increase even further. Now, if the capacity is same and if the demand is increased significantly, then copper prices will rise. Definitely, we are in a situation where over the next 5-7 years, I think crude prices will remain firm or will remain elevated, whichever way. I don't know exact levels, but I think they'll remain at $100, at $100 or plus $100. Now, obviously, friends, that's a big negative for India because all of us know that we import 85% of our energy requirement. So India is dependent on the external world, be it Saudi or Russia or Iran or Iraq, for importing our or meeting our crude oil requirements because our consumption is far higher than our domestic production. So yes, to that extent, if crude prices rise, it will hurt India. So I think that is one big challenge for India in terms of our macroeconomic vulnerability. But I think we'll have to learn to live with that, and probably over a longer period of time, we'll have to find some strategic solutions to that. Probably over a period of time, once clean energy, renewable energy, blue hydrogen, green hydrogen, that's being all been talked about, and what do you call your fuels coming out of your biogas and stuff like that. Once they become some meaningful proportion, probably we'll be able to moderate or reduce our energy dependence on the external world. But for the time being, yes, meaning Indian economy still can manage a crude of meaning see, every dollar hurts, but I still think that at $100 of crude or $110 of crude, India can still do a 7% growth, if not more, and probably more over a longer period of time. But if crude prices go beyond 110, 120, then it will certainly, and if they stay there, if they go for there for 2-3 months and they fall, no problem. But if they stay permanently above, let's say 120 and all of that, then it will hurt India's growth. So yeah, that's one big risk, friends.
Thank you, sir. So when talking about this demand and supply thing, and talking about the thing, the trade deficit doubled in August and reached around $61.9 billion. Though experts are positive about the stability of the Indian economy, how can we factorize the trade deficit and weakening of dollars in our economy? No, this is
So yeah, good question, Akshara. So see, the point is, in a growing economy like ours, which is growing so fast, we're growing because when please understand, friends, a $3 trillion, $3.2 trillion economy doing 11-12% nominal growth, we're adding $350 billion of GDP every year. Yeah, so that's very significant. So in a growing economy, consumption will grow and imports will grow. So our trade deficit will remain high or elevated in that sense. I still think that as long as we can keep our current account deficit around 2-2.5%, we'll still be fine. We can fund that current account deficit of 2-2.5% because we get significant amount of foreign capital inflows into our country via both FPI flows and FDI flows. And FDI is long-term flows. And on top of that, we get a lot of transmission from NRIs who send money to home. India probably is, I think, the second largest country in the world to receive remittances because there's a huge Indian diaspora all over the world and they keep remitting money and which will offset all of this, apart from our services export, offsets our trade deficit. So sum total net, as long as we can keep our current account deficit under 2-2.5%, I think we'll still be fine. We can manage that. A current account deficit more than 2-2.5% exposes our macroeconomic vulnerability. But I think we should be able to manage that. And with this PLA and all of that, while imports are increasing, our exports should also increase. So that's on the trade deficit. On the currency side, I think Indian rupee is in fact actually a very stable currency because you see, I know that we've had a depreciation of about 6-7% in the last 8 months. But before that, for almost 3.5 years, the rupee was almost stable at around 74, 75. Yeah. And even in the last 8 or 9 months, probably INR or Indian rupee has been the best performing currency, because every other currency has depreciated against the dollar much more than Indian rupee. You look at the pound sterling in UK, you look at the euro, you look at the Asian currency, you look at Brazilian real, you look at the Indonesian rupiah, you look at the South African rand, you look at the Chinese yuan. All of these currencies have had depreciation which is versus the dollar which is much higher than INR. So in that sense, I think rupee is emerging as a much stable and stronger currency. So I will not be too worried about currency as such at this point of time. And also the fact that now RBI at $600 billion of forex reserve, RBI is also the third largest, I think the fourth largest holder of foreign exchange reserves. So RBI has a lot of firepower with them to defend the currency if the need comes to, if it comes to that stage where if there's a run on the currency or something like that, and RBI has to intervene aggressively to defend the currency, then RBI can certainly intervene and do all of that. So I'm not too worried about currencies, but yes, we should, as a country, contain a current account deficit under 2.5%.
Okay, thank you, sir. We have Mr. Ganguly asking about financial sectors in short and medium term. He probably wants to know how bullish is financial sectors in your eye.
I'm extremely bullish on financial sector, because I think there is huge underpenetration of financial services in India. Indians, if you look at borrowings, Indian consumers don't borrow. They're conservative, so they don't borrow as much. People still like to pay significant amount of money when they're buying a house. They like to pay significant amount of money out of their savings rather than take significant home loans. People don't borrow so easily. So if you look at consumer borrowings in India, is not very significant. Likewise, when you look at savings, still apart from real estate, 60% of savings in India still are parked in bank fixed deposits, and there are a lot of other asset classes which deliver returns which are much higher than that. So when I look at each and every segment of financial services, I find tremendous opportunities in them, and which is why I am extremely bullish about financial services. You take it from a 1 year, 3 year perspective, 1 year, 3 year, 5 year, 10 year, across time horizons. In fact, when you talk about stocks also, you see over the last 4 or 5 months, banking stocks have been the best performing stocks. They've been outperforming the broader Nifty market by a wide margin. And that is reflecting that we've already started seeing a trend for the last 4 months where banks are outperforming and IT is underperforming. And I think this trend will continue probably for the next year or so, to my mind.
Thank you, sir. Thank you. Thank you for this wonderful webinar. So we have come to the end part of it. So we have a lot of questions coming up, but yet the time constraint, we are unable to answer everything. So kindly, audience, please mail the questions to events@pmsbazar.com. We'll make sure that every question of yours is answered. So thank you for your time, sir, and thank you for this insightful webinar.
Thank you, Akshara, for hosting us. Thank you, PMS Bazar, for hosting us, and thank you, friends, for all of you to taking your valuable time out on a Friday evening, because I'm sure there are many more exciting things to do on a Friday evening when you're closer to a weekend, and when you take time out for a webinar like this, that shows you're really interested in this. So I really appreciate your time. So thank you, friends, for taking your time out for joining this evening. And yeah, please mail your questions to Akshara and our team at PMS Bazar, and we will answer all of those questions. Thanks a lot.